it's my privilege to introduce CA Pradip and Kapasi sir. He is a chartered accountant and a law graduate from Government Law College. He leads the chartered accountancy firm located at Mumbai. He is the past president of the Bombay Chartered Accountants Society and the Chamber of Tax Consultants. He has co-authored many professional books like Taxation and Accounting of Shares and Securities, Fringe Benefit Tax, Search, Sager and Survey, Stamp Duty, Digest of Case Laws, a Tax Companion, Taxation of Firms and Partners, International Taxation, some important aspects, Wills and Successions, Hindu Undivided Family Law and Taxation, Search and Sager, Book, Block Assessments, Special, IT Assessment Procedure. He is a regular contributor of articles in professional magazines and various newspapers, such as co-author of Monthly Future Controversies in BCA Journal, the Economic Times and such other leading newspapers, Income Tax Review, the Chambers Journals, AAFTP Journal for Tax Professionals. He is on the editorial board of the Chartered Accountant Journal of ICAI, the Chambers Journal, and discharge editorial functions for All India Federation of Tax Practitioners Journal for Tax Professionals, BCA Referencer cum Diary and Income Tax Review. He has addressed conferences, seminars, and for professionals, tax officials and trade associations across the country on the subjects of direct tax laws, stamp duty and allied laws, and has received several awards for his professional contribution. He was a lecturer and visiting faculty at the Jamnalal Bajaj Institute of Management Studies on the subject taxation for 12 years and at IIM on the subject corporate taxation. He is a regular trekker and is fond of traveling, and with his team engages in the social and charitable works through a small initiative, Prayas, through winter warmness drives in tribal areas of Maharashtra. With this brief, I take pleasure in introducing Pradip and Kapasi sir. Over to you, sir, to take the presentation.
Thank you. Thank you, Rahman sir. Thank you, speaker sir. I welcome you, sir, for this program.
Before we hear Pradip Kapasi, we have a pleasant task to do. May I now request Conference Director Palguna Kumar sir, along with the next speaker Subramanian sir and Purushottam sir, to come forward and present a shawl. This is a special shawl brought by Palguna Kumar sir from Tirupati. Purushottam sir. That's a special shawl from Tirupati.
Sir, camera le Palguna Kumar sir varla.
Sir. Oh, camera venuma.
A health bouquet and a memento.
Oh, that's small thing, very small. Thank you.
Thank you, Palguna Kumar sir. Thank you, speaker sir.
Let us hear from CA Pradip and Kapasi sir on the critical analysis of new provisions. Over to you, sir.
Chairman SIRC, the office bearers, Mr. Sundarajan, my very dear friends and co-speakers for the day, my seniors, ladies and gentlemen. It's my pleasure to stand before you and participate in this proceedings. Visiting Chennai also has been a special pleasure because, I'm from a place, which is predominantly Tamil place, And since my birth, I have been around Tamilians, and all our food habits, all my family food habits are all South Indian food. We love that. So therefore, I don't miss an opportunity whenever there is a possibility to visit Chennai. Only that to yesterday what I missed was that I reported around 11 at night, and so there wasn't much opportunity. So maybe I wish to make it up today, after this talk is over. So we'll try to do so. Rahman asked me that, would you prefer to talk from while sitting, or, you would do while standing? So I said that, whenever I present my case, I always prefer to stand because I've been trained to stand. I'm a person who is married for more than 35 years. So whenever I need to present my case before my wife, I have to stand up. So that habit continues. Yes, that habit continues. I congratulate the course director, Mr. Falguna Kumar. He is a good friend of the years. And today he told me, he told you that yes, that when you put certain questions to him, he said that yes, that either me or Mr. Ramasubramanian would answer. That reminded me of the famous episode of Albert Einstein. He was asked many questions by many people, and most of the questions, he was a brilliant person, so he would answer them very simply. But some person like one of you today, asked a very difficult question. And he was taken aback, so he had no answer. So what he did was that, that he said that, this is a very simple question. I would not waste my time and your time on this. My chauffeur who is sitting outside would come and answer that. So here he did the same thing that, he said that, okay, either me would answer or Mr. Ramasubramanian, like his drivers or chauffeurs, we would try to make up for that. So don't worry about it. Is that the only thing I request you to be with is that, please pay attention. See, we are dealing with a subject which is absolutely new. More importantly, it is one of the very complex subjects, see, which has been introduced in the recent years. And the third and equally important is that we would be dealing with something which all of us are otherwise also hands-on into this work, in the sense that it is practice of partnership laws. And therefore, most of us have good number of partnership clients. So therefore, it is essential that yes, we understand, respect these amendments and try to understand. Yes, I'm aware that, that it leaves, lots of loose ends, and may take, courts years before, say we really understand and appreciate these laws. Many of the introductions, I mean, the amendments which have been made, perhaps maybe something which could have been made simpler also. And I don't see that, okay, in the times to come, it could be simplified by further amendments. Making further amendments will make this further complicated. So understanding this, see what I have done is that Mr. Falguna Kumar has designed the course in a manner that he will introduce you to the subject, which he has nicely done. So I have a basic understanding that now you all are basically familiar with what we are going to discuss, and therefore I am asked to deal with the critical aspects of this. And there are a number of critical aspects, so therefore we will try to see that yes, in the time which has been allotted, I have been asked to close this by 1:45 or thereabout, so we'll try to do so. And in the process, we will take up these critical issues one after another. You may pardon me if there is some overlapping in the talks by Mr. Ramasubramanian or me, or even by Mr. Falguna Kumar, because it's inevitable. When you deal with certain critical issues, you perhaps will have to revisit, the basic provision which one is trying to. I would take utmost care to not revisit and repeat something, but wherever it is absolutely required, you may pardon me for having done so. This is the synopsis of what we are going to deal with. I'll just make you rush through this, so I'll not repeat them because each of them would be considered in detail. So first, what we have done is that, these two sections, though they are poles apart, one is South Pole, the other one is North Pole, but there are issues, which are common to both the provisions, 9B and also 45.4. So we will take up those critical issues concerning and which are common in both the provisions, and thereafter switch over to the independent provisions. The first is the retroactive application. Now, as you would see, this provision, received the assent of the President on 28th of March 2021. However, the provision is made applicable for the entire fiscal year 2021, that is assessment year 21-22. So therefore, 362 days you were not sure of this provision, and before almost 330 days you had not even dreamt that there could be a provision like this. So in these circumstances, the first challenge is whether we would apply this law, which has become a law only on 28th of March 2021, for the entire year commencing from 1st April 2021. To cut the issue short from beginning is that there is a plenty of developed law on the subject which says that yes, two things they say. One is that if the law is made expressly retroactive or retrospective, then that be it. Legislature has the competence and the power to do so. So if it is not expressly done, normally in such circumstances, it would be considered to be prospective. However, in this case, what we are presently discussing is not retrospectivity. We are just discussing it, whether the law was passed during the year. The answer is before the end of the year it was passed. So the simpler thing could be that before you, that it is the law would apply to you. Only whether all the provisions could be read down or could be understood differently is something as we travel, we will try to understand. But this first thing is that yes, the law would apply to assessment year 21-22 and subsequent years. The next following question is that retrospective application. As long as retroactivity is concerned, perhaps, as people who have been in practice for donkey's years, we respect that, and we also would not like to waste our time on fighting the retroactivity as far as AY 21-22 is concerned. But if I turn around and tell you that it could even hit those years which are prior to AY 21-22, then you will have a serious difficulty. For the two reasons. One is that yes, that the law is not made retrospective. It is not applicable to assessment years prior to AY 21-22. So therefore, if there is some event which I identify, which will make you feel that there is an element and a color of retrospectivity, there is a difficulty. And what is the example which is placed before you is that take a case of a firm which was reconstituted or dissolved in financial year 1920 under a proper valid document, instrument of partnership, which provided that the relevant partners or the retiring partner or any other one would be receiving some asset and some consideration after the end of the year. And that receipt would fall in AY 21-22, it could fall even in AY 23-24 or 22-23. The issue which is to be considered is that the law has not expressly considered this situation, but the law has ensured or provided that compliance of one condition will attract tax. And what is that condition? The receipt of a capital asset or some other money or a stock in trade from the partnership. Then in such case, the year of receipt is taxable, is the year of taxability. In such case, there is a color of retrospectivity. The question which arises for our consideration is whether the law would apply, or there could be some working management to apply the law. And if it is made applicable, what could be the options before you? My answers before you are this, that yes, the law expressly provides for taxation in the year of receipt. It is not concerned about the year of reconstitution or dissolution. So if the law is read as is made available to you in print form, then in that case, such a situation could be covered. Such a situation could be covered. I have repeated this particular issue later on with some case laws to identify that in similar circumstances under 46 or some other provisions, whether the law has been applied or not. And after that, we will come to a conclusion that whether retrospectivity is possible or not. Important today is that we identify all possible issues. It may be that yes, that we may not be come to some unanimity about the solution. But once you have identified the issue, you are all as chartered accountants are trained to take or should be trained to take your own calls. So therefore, you may not be swayed by my views, but you may still consider and respect if possible about the views. Important thing is, and this is something, which is applicable to several of cases, wherein the payments are yet to be made in respect of transactions which are concluded some 5 years back, 6 years back, because the payments are staggered or for some reason, because the payments were under dispute and in the court cases. Now, based on the court orders or arbitration orders, the payments or the assets are being received today. And therefore, in such cases, whether this would be applicable or not. And if it is not applicable, then in that case, important thing is that would the old provisions of section 45(4) be applicable or not? For the reasons that you also had almost identical provision as that of 9B. The old 45(4) has no relation whatsoever to present 45(4). But 9B is somewhat, brotherly to the present 45(4). So I mean the previous 45(4). So in such circumstances, could one turn around and say that, all right, sir, if you do not wish to apply it retrospectively, then in that case, I would invoke the provisions of the erstwhile 45(4) and would bring tax in the year in which the event had happened. And what was the event? Not of receipt, but of a reconstitution. It's not altogether ruled out. There are some difficulties over there that it tries to tax you on distribution of a capital asset in pursuance of a dissolution or otherwise. The courts are reasonably clear in holding that the term or otherwise includes retirement also. So therefore, the short issue is that whether there was a distribution in that year or not. Now, if the authorities are able to prove that there was a distribution, then you might be taxed under previous 45(4), provided the time for application has not expired. Most of this discussion, which is going to happen in the courtrooms, in the next few years would be about understanding the true meaning of the word receipt. Because the taxation is entirely revolving about, the year of taxation is about the receipt. Like Mr. Falguna Kumar just now said, if there is no receipt, there is no tax. We'll see whether that is so. But the point here is that if there is a receipt, then there is surely a tax. So therefore, what is important is we need to understand what is a receipt. Receipt is a word which is widely used over the entire Income Tax Act. 56(2)(10) is a classic addition of this, that which also uses the identical language received. So here is a case that where you receive something, then what it would be. So something which is placed for your consideration is that simplest possibility is that I physically actually receive it. I receive it. Now, ordinarily, the issue is that what is a receipt? Once again, legally, a person receives money with a liability to refund it is not a receipt for the purposes of taxation, because it does not put you with a right, does not waste you with a right of disposition. It remains with you, but there is an obligation to return it. So a loan could be a receipt, obviously, yes, but it is not a receipt which is envisaged under the body of Income Tax Act. So it's surely not a simple receipt. Even if it is actually received, Assuming that a partnership gives you 10 crores of rupees, see, with an obligation to refund it, like, they would debit your withdrawal account. Now, one would not believe that this is a receipt which we are going to talk about. And such situations, you can trust my experience that even such situations would happen. Such situations would happen where under withdrawals also are sought to be brought under the net of 9B or 45.4. So coming back is, to me, a receipt would mean an actual one view, an actual receipt with a right of ownership and also the right of disposition. If I have an absolute right of doing something with the receipt, with the asset, in a manner which I desire, I have a right to transfer it, then that is the receipt which we are talking about. A physical possession by itself should not conclude. This is one possibility. If you open the Indian Contract Act, or even for that matter, the Sale of Goods Act or the Transfer of Property Act, there would be numerous cases, say, wherein what is the receipt is something which is examined. And in different contexts, for immovable properties, it's differently held. There the transfer is relevant. For sale of goods, for movables, it's differently held. Sales is important with the preconditions or an unattached condition sale. So these are and Contract Act also looks at this receipt, of a consideration differently. And therefore we have different receipts, possessory receipts, constructive receipts, and so many, right? So in case where I'm presenting the second view is that in a case where there is no physical receipt, the money is yet to come, could you still be said to have received the money? Could you still be said to have received the money? The other view is that why not? Why not? Once a reconstitution happens or a dissolution happens, the instrument records your right to receive it. Instrument under the Partnership Act and the LLP Act also creates a debt against you. Then in such circumstances, could you still say that you have no right? If the partnership deed carries on further, and if your lawyers are careful to provide that you will have a right to deal with your debt in a manner in which you feel. So you will have a right to provide for legatee in respect of that debt. You will have a right to nominate some person. You might have a right to receive interest on these dues. Then in such case, could you still be saying that, it is not an actual receipt? And therefore, the word receipt here should be understood in inverted commas, nothing beyond that, nothing more. I would not like to take such a view. I would believe that any due with a right of disposition and ownership, irrespective of the physical receipt, could be construed as a receipt. So if you are enamored with an idea that you would not want to pay tax, you would want to defer the tax section, then in such case you would be advised to not to create a debt in your favor under the instrument of partnership. A clear-cut provision should be recorded that, not on or before 31st March 2024, the retiring partner would have a right to receive. He would not have a right to receive. Accounts would be settled for that year, and thereafter only the right to receive would emerge. If you take this kind of a care, possibly there is a case for deferring the year of taxation. But in your eagerness to defer the year of taxation, you may put the partner, the erstwhile partner, in some legal difficulty, whereunder the continuing partners may at some point of time may keep on dilly-dallying with the payment. So therefore you will have to take your own call. What is important for receipt, irrespective, it's either an actual receipt or a legal receipt. Make no mistakes about it. I am in favor of a legal receipt, a constructive receipt, but that would be an actual receipt also. Once again, this is going to be, we will discuss this in another 10 minutes. So therefore, we might, come to a different conclusion. But the important point is that the method of accounting is not relevant at all. Your method of accounting, whether it is cash, mercantile, all this, it will not decide whether there is a receipt or not. Constructive, possessory, or legal or actual, you may take your own. The character of a receipt would be decided with reference to the partnership firm. Whether a particular asset was a capital asset or not, or was a stock in trade or not, would not be determined with reference to the recipient. He might treat this as stock in trade, though it could have been a capital asset in the hands of the partnership. But as I see the way the law is worded, it would be the case, it would be the character which would be determined with reference to the partnership firm and not the partner. The last thing on this receipt apparently is that there are two events which are happening in 49B and also 45 4As. One is that it deems a transfer. It deems a transfer. The other one is that, it taxes the receipt in the year of taxation. Now, we have traditionally been trained to believe that, that the year of acquisition is the date of purchase. The period of holding starts running from the year of purchase, irrespective of the fact that whether I have possessed the purchased item or not. So in such circumstances, there could be a slight dichotomy in determining the period of holding of the partner who has received it for the eventual transfer in his hands, assuming that he holds it and later on sells it. I would take a call that in such cases, what is relevant is my right fructifies. My right fructifies on transfer. And if you have on your own volition understood that by deeming it to be a transfer, you meaning the finance minister has agreed that it is a case of a transfer, then my period of holding should start unless otherwise established. Receipt is irrelevant. Receipt is not an event to determine the period of holding. If somebody does it, maybe he has good luck, but I don't think it's legally supported. So this is yet another thing we will keep it in mind. There is a difference between a receipt and receivable. Legally speaking, when I say that, okay, a constructive receipt in law could be a receipt, I may not be off the mark. I may be right also that under the several civil laws, a receipt could include, even a possessory receipt. It could include even a constructive receipt. In case of possessory receipt, one more point we should keep it in mind is that, there could be cases wherein, the person may be already sitting in possession on the asset. There could be, see, right, yeah, I am a lessee of the premises and now I have been given the ownership rights of the premises. Now, in such case, see, I don't need to exit from the premises to assume the ownership. It's just is wasted in me. Now, in such case, could you not say that the year of receipt was way back in past and therefore there is no taxable event? The answer is no. This again supports that, a simple receipt, a physical receipt is not relevant for the purposes of our discussion. For the purposes of 9B and 45.4, what is important is a physical possession with the right of ownership and, importantly, to me, a right of disposition, a right of nomination. If all these come together, then it is a receipt, not otherwise. So coming back to this is, why this is being brought to you is that it may be true that, that I may not be wrong in saying that a legal receipt is also a receipt. But is it really so under the Income Tax Act? The answer could be may not be. For the reason that the Act has extensively been using different terminologies with reference to a receipt. Somewhere it says receipt, like what it is saying in these provisions. Somewhere it is saying receivable. Somewhere it is saying due. Yeah, somewhere it is saying talking about interest bearing. Then in all such provisions, there is a scheme of this Income Tax Act which envisages these provisions, these words to be differently understood and should be differently meant for. So in such circumstances, even though in spite of what Falguna Kumar said that under the Indian Partnership Act, the right to receive emerges. on expiry of few months or immediately on retirement or on the basis of the contract or the document. But the terms due to, payable, receivable and receipt, Supreme Court had an occasion to examine these words. And they said, if the court said that these are differently meant, they may not necessarily mean the same thing. Under the circumstances, we may be tempted to once again come to a belief that, actual receipt with right of possession and the right of disposition alone would be taxed. And therefore, if a debt is due to me against the firm, even on retirement, even it is recorded so in the books of account, it may still not be a case of a receipt. So this is the other view which appears to be a rational view to me, not because of the legal provision, the general law, but because of the tax laws which has the occasion to examine these things differently and use them differently. We have two cases. One is this Reddy's case and the other one is Mumbay's case. So if time permitting, you may look into that. Moving further onwards is, take a case of a receipt via legal heir. A partner who was a partner retires from the partnership firm. The document records his retirement. The document promises to give him the money after 2 years. And in between, an unfortunate event happens that the person passes away. Then in such case, the right of the legal heirs to receive is not defeated. Is not defeated. It would continue. But the recipient here now would be a different person. Recipient here would be a different person. A partner was to receive the money as a partner who had retired from the partnership. A legal heir would receive the money as a debt due to his father, not as a partner. He was never a partner. So then in such cases, could you not turn around and say, considering the fact that these provisions are extraneous provisions, they are fictions, trying to tax something which otherwise may not have been taxed, then in such circumstances, a receipt on a literal interpretation by the legal heirs is not fitting into the definition in explanation to section 9b, which defines who is a specified person. A legal heir is not a specified person. And both these provisions very clearly provide that receipt from a specified entity by a specified person is alone taxable. So there is a good case to hold that you might feel that it is stupendous to allow a person not to be taxed. But I will also believe that it is also equally stupendous to tax a transaction which was never taxable. You bring in colorable, devices in order to tax a person in situations which otherwise nobody could even dream of taxing, then obviously you will have to stay with that. So this is my answer to that, is that yes, if you are enamored with 159, I would take a view that 159 has a very limited application. It is in respect of taxability of a deceased up to the date of death and not thereafter. So this is a receipt-based taxation, which event itself has happened post-death. So therefore, 159 has no application. Similarly, 56(2)(10) would not be, because the legal heir what he would receive, is receiving out of the estate of the deceased father or the person. And therefore, in such case, it is specially saved by one of the exceptions of 56(2)(10). So there should not be a difficulty over there. Receipt from successor of a firm. This is also an interesting thing. Take a case of a partnership who retires a partner. And thereafter, without making the payment, is converted into an LLP, is converted into a company. Now, in such case, the liability to pay to the erstwhile partner continues, is taken over by the successor in all good spirit. There is nothing to cheat anybody. The successor now would make the payment of the dues to the erstwhile partner. Now, in such a case, could it be said, this is different than this specific person, now it is specific entity. Now the specified entity is an entity, is an entity, which is not in existence. Entity on succession has ceased to exist. So therefore, in such view of the matter, the issue that could arise for consideration is that in this case, could it be said that yes, that payment is not from a specified entity? The answer again, literally and interpretationally also, appears to be so that in such case, the charge would fail. The charge would fail. Receipts in installments. This is common. You all would come across this. Huge payments, dues to the retiring partner are never paid in one shot. Even if they are agreed to be paid in one shot, the payment is staggered over a number of years. So in such cases, and at the most, if the firm is kind, it will reward you with some compensation, damages or interest. That's it. The point here is that if it is paid in installments, say a person is to be paid 40 lakhs of rupees over a period of 4 years, 10 lakhs each, equal annual installments. His capital contribution as on the date of retirement is 10 lakhs of rupees. For the purposes of 45(4), in specific, but even otherwise for 9B also, is that what would be the year of taxation? That is the first challenge. Is it, if the receipt is staggered, then if we have agreed to take a literal interpretation of the term receipt, then actual physical receipt is something which we are talking about. So should it therefore not be that, these 40 lakhs, 10 lakhs each would be taxed in 4 different years? Not a very difficult answer. It's possible that it would be taxed in 4 years unless the authorities succeed on constructive receipt taxation, which according to me may not be possible. The other back-to-back question which arises for consideration is that what would be the amount that would be deducted? My capital is 10 lakhs. The cost of asset also is 10 lakhs of rupees. Indexed, substituted, everything comes to 10 lakhs of rupees. Will I get a deduction of 10 lakhs rupees? If the answer is yes, then which year I will get the deduction? In the very first year? Then therefore in the very first installment on receipt of it, I will not be paying any tax. Or should you again, be, as they say, politically correct by spreading it on 4 years by claiming 2.5 lakhs rupees? Now suggesting such thing would not be correct, at least, see, for the reason that the law doesn't provide for staggering the cost of deduction also. That's not possible. But the authorities might be tempted to do so, that if you are showing a part of the receipt due to you, then there is a difficulty. I would take a view that yes, that I should get the deduction of entire amount in the very first year, because that is what is granted to me. Entire amount in the very first year. The third question also is that should I not be tempted to claim this amount once and again every time? Every time you are taxing me, every time I will claim that amount because that was the amount which was deductible. So is it not ruled out? The answer is perhaps not ruled out, but the law is consistent from Escort's time that yes, that a double deduction in law is not otherwise envisaged. So therefore, there is a difficulty of claiming a double deduction, triple deduction, or a quadruple deduction. But on the first two, the law seems to be with me in the sense that yes, that it would be taxed in the only up to the installment which I have received based on our discussion of the past slides, and that in the very first year I should not be allowed to frustrate that deduction. It is in your interest to advise your client to claim it in the very first year. I do not think that you would be violating 270A. It's not a case of misreporting or underreporting. Can never be so. It is an interpretational issue. So I'm a bona fide belief. So in this background, there would be a possibility of taxing installments in the manner in which we discussed. then there could be a case of a failure of receipt also. Now, after having agreed to make payment within 2 years, the person doesn't make, person meaning the payment within even 5 years, 4 years, 3 years. Then in such case, maybe you are patient enough to defer the taxation because you have not received. But when 4 years happen, is it not that, the case is concluded, closed, and therefore then in such cases, the question of my receipt being taxed on a receipt which I might receive it after a fierce litigation after the end of 8 years could be very different. Could be very, very different. It would be incorrect on my part to thereafter claim that what I am receiving in the 8th year is on account of what I had agreed to receive. That would be a different litigation, different fight. So therefore, and the color of receipt at that time could be against the dues, which were receivable, but then it is the right to receive that would arise on account of pursuing it in a lawful civil suit. So I would keep my fingers crossed. I am not saying that yes, that it would not be possible, but apparently appears to be that when a receipt fails, then in that case, the liability or the charge also should fail. The liability or a charge should fail. For the in an unfortunate event wherein you have been taxed or you have been advised to offer it on a constructive receipt basis, in such case also, I would believe that if possible, if there is a scope for rectification or a revision, you should try to refresh your return of income and try to see that you are not eventually asked to pay tax on it. Even if the time for revision is over and if for some other dispute you are in appeal, there could be a possibility of claiming this in the appeal by way of putting up a fresh claim, either before the Commissioner appeals or even before the Income Tax Appellate Tribunal. Your journey would end with that. This is something Falguna Kumar has already answered, that there could be a receipt, that, wherein there is no reconstitution, there is no dissolution. In such case, whether 9B will bite you, 45(4) will hit you, the answer is no. Answer is no, and to that extent we agree with sir. But then, the question could be that could this receipt still may be taxable? Could this receipt still may be taxable under the normal provisions of section 45? Now under 45, there is a overall overwhelming charge under 45(1). The rest of the provisions 2, 3, 4, 5, 6 are deeming fictions. So therefore, if there is a transfer by a firm to a partner, whereunder the partner assumes an exclusive interest over a joint interest, then in that case, there could be a possibility of it being taxed under 45(1). But it is a different challenge. You have scores of Supreme Court cases, at least 3, whereunder the Supreme Court has viewed this taxation little differently. The cases which are important are L. Raghukumar's case, Mohanbhai Pamabai's case, and also Tribhuvandas Bimji's case. These are the cases wherein the courts had, Apex Court had held, Supreme Court has held, that such receipts in certain circumstances may not be taxable. So if that is so, then you do not need to fear about it, but it is something, it cannot be simply ignored. It cannot be simply ignored because the department is of a view that such receipts are taxable. In fact, recently in one of the Bangalore Tribunal decision, Vice President Vasudevan has held that such receipts could be taxed under a different formula, very different formula. So therefore, the issue to me has not yet died down. Issue continues to be a challenge, and therefore you will have to take your own call as far as 45(1) is concerned. Receipt of cash equivalent.
What is your personal view on this?
I am
45(1) for a drawing by a partner.
I would take a view that, okay, that if it is fitting into the ratio of Mohanbhai Pamabai's case, wherein a person has been paid in accordance with what was due and entitled to him, then in that case, that receipt cannot be taxed.
All weapon orders apply.
Yes, should apply. There is no doubt. Only that Vasudevan as your, your friend has made a difference. So you will have to look into that. That is what it is. Right? And he is a person, one of the few members we respect a lot, because he is otherwise erudite. Right? Yeah. Only that these days he goes overboard. So that is why one has to be a bit concerned about this. Is right. That this is a cash equivalent. Now see what happens is that 9B provides for tax in respect of transfer or distribution, whatever you would call, a capital asset or stock in trade. Any payment of a sum that is cash or basis is not covered under 9B. When it comes to 45(4), it doesn't cover stock in trade, but covers a capital asset and sum payable, anything, right? That sum payable normally would be something which is paid by check or cash. That's how it would be, and not in kind. This is, to a simpleton like me, this is what is understanding. Now, in between, one would believe that either it is in kind or in cash. But is there something in between which is hanging like a Trishankhu? The possibility is that there is a possibility that there is a concept called cash equivalent. A cash equivalent is something, which is in the form of a security which does not appreciate in value, but it is almost cash. It's almost cash, like Indira Vikas Patra, Kishan Vikas Patra, National Savings Certificate. All of these are considered to be assets, even to an extent, even FDs with the companies, may not be with banks. So therefore, these are considered to be not cash, but they are considered still to be cash equivalent. And for the purposes of Section 48 and indexation, the courts are consistently holding that they will not be entitled to indexation. Now, in such view of the matter, the question which I am putting for your consideration is that in these kind of a cases, can one say that what is paid to me is neither a capital asset nor it is a cash. It is neither a capital asset nor it is a cash. Why not a capital asset? Because the tribunals are saying that it is not possible to index this. This is not a case of a capital asset. And that can be transferred for a profit or a loss. So therefore, no indexation, no substitution, all such things, and no benefit of reinvestment. So in such case, in such view of the matter, there is a possibility to hold that 9B at least should not apply to this case. See, what is happening is this is a serious dual taxation thing, wherein, it hits below the belt of a person who gets into such kind of arrangements, whereunder there is a retirement and payment. First, the firm is taxed, again the firm is taxed in respect of the sins of partners, and first it is being taxed in respect of its own actions. So therefore, anything which saves me from dual taxation at least is something I would keep on trying, as long as you prove me wrong, as long as I am not being penalized for this. I feel there is a case for this, and therefore one would try to. But when it comes to 45(4), I also have no doubts in my mind that this cash equivalent would be considered as cash. Cash equivalent would be considered as cash, and therefore there should not be, an escaping taxation from that under 45(4). Withdrawal of stock without change, again, see, there should not be a difficulty here. Yes, the only thing which I wish to bring before your attention is the famous Supreme Court decision in the case of SIRC ICAI Premchand. It's 100 years old decision, wherein the court famously stated that when a person withdraws the stock, there is no taxation. And court explained it also that if you transfer something from one pocket to another pocket, then in that case, there is no transfer. You can't transfer something to yourself. I fully respect it. We have planned, see around this and succeeded it also. The issue which one has to appreciate in the context of partnership, when you withdraw the stock from the partnership, the Supreme Court famously, again in Sunil Siddharth Pai's case, stated that there is a transfer. On admission also there is a transfer. It's another story that it cannot be taxed because of the failure of the computation provisions. So therefore, when there is a transfer, and why did court say that there is a transfer is that there was a joint interest which became an individual interest, or an individual interest which becomes a joint interest by introduction or withdrawing it from partnership, from whichever ways it is. Then in such case, there could be a taxable event, and you could tax a person provided the tax mechanism made available helps you to tax such an income. If it fails, good luck to the authorities. But if it does not, then in that case there is. So in this background, once again taking a clue further from this is that 45(1) is an issue. And in this, besides 45(1), there is an issue of section 28 also. That is something which also one has to, from a joint ownership, you provide an exclusive ownership. The firm is divested of the ownership of a stock, and you still do not wish to tax it. That is a difficulty. So in such case, read with the old decision of the Supreme Court, that's Madras High Court, differently held, decided by the Supreme Court, is ALA firm's case. Is that in such case, see, when the stock is taken away from the firm, whether the market value of the stock is to be taken into consideration for deciding the liability to taxation is an open issue. Again, after the introduction of ICDS 2, which is now a statutory prescription under 145, there is a possibility that such stock or withdrawal of stock could be exposed to taxation. There is a good possibility to do so. But there is also a reasonable possibility to defend such case. Receipt from third party. Again, see, we are just testing different situations. It's not that, this is something, whereunder, say, it's kind of a rocket science, or I'm expressing my intelligence. It's not exhibiting that. It simply is that the mind is full with all options, opportunities, and all other, possibilities. So one is trying to examine that. So what is this, that when instead of the specified entity making you the payment, if the payment is made by a third party, say for simplicity, a partner who is joining the partnership firm, or the partners who are continuing with the partnership firm, if they agree to pay you as a reward for permitting them to change their profit sharing ratio, then in that such a case, could 9B or 45(4) be invoked? The answer appears to be no. Again, it is not from a specified entity, which is clearly defined in explanation 2 to section 9B. So therefore, please look into this. A similar thing would be there in 45(4) explanation 1.1. Then we have the concept of fair market value. Yes, this concept of fair market value. Both the provisions at some point of time provides for taxation on the basis of fair market value. It's not that this fair market value is going to be taxed, but it has some role to play, an important role to play. Now this fair market value, what is it? Normally we have sets of provisions which say that fair market value would be the higher of the stamp duty value, or the value it prescribes. It is determined as per the rules, or the something which is the value which is available, in the market or in the open market. Now, in this background, the issue which we have to see is that fair market value is also prescribed for stock in trade also. So when we look into the definition clause, section 2, we see that 2 subsection 22B provides for definition of fair market value. And it's something which is available, in the open market. But on a deeper reading, one feels that, okay, 229B has an application only for the purposes of capital gains and capital assets. So therefore, when it comes to stock in trade, When it comes to stock in trade, this FMV under 222B is not available. So when that is so, then you will have to have your own way of determining what is the fair market value. What limited point which I am putting before you is that 229B and the open market valuation or the rule valuation is not something which will presently come to the rescue of the government. You can find out your own fair market value depending upon several restrictions, limitations, and the caveats. So this is one. Then this fair market value also has a difficulty when it comes to that in the course of the retirement, I as a partnership firm agree to transfer one of my businesses instead of assets, instead of cash payment. Then in such case, see, how do I determine the fair market value? How do I determine the fair market value? The rule valuation may not help. To me, even section 50B value also could not help. 50B itself is a fiction. You can't introduce a fiction over a fiction. There is an endless motion. So in such circumstances, it would be appropriate to hold that either the charge could fail, which is a little, say, aggressive view. But in such circumstances, a valuation which takes into consideration the liabilities is very important. 50B at times, ignores certain liabilities, certain revaluations. 50B specifically ignores revaluations. But when it comes to slump sale, for the purposes of our limited discussion, we are examining this particular aspect in an absolutely narrower scope, that whether slump sale could be valued at fair market value as per rules or as per section 50B, the answer to that is no. Whether therefore I should be permitted to take into consideration the liabilities, the answer to that is yes. Whether should I therefore also be permitted to take into consideration the revalued assets figures, that is assuming that it has already been revalued, then in such a case, can I take that also into consideration? The answer is it may be possible, it may not be possible, for the reason there is no express prohibition against that. There is no express prohibition. If an asset has been revalued, it's different. But if a business is revalued, it could be different. So one has to keep that in mind. Then the dimming fiction is that. The dimming fiction, the law is these days replete with fictions. One day it will become all fictions, like, in some of the countries like Indonesia and all. Irrespective of what you actually earn, the tax is not on an income anymore. Based on your turnover or your capital or some yardstick, it is decided that your income should be an X amount and you should pay 15% of that. Period. This is the way it is. So the way we are progressing with fictions, in a short time of about a decade or more, you have so many fictions. And on top of it, there are yet more many fictions. The issue which is to be considered is that in determining the fair market value, under 9B or 45.4, will these provisions of 50C, 50CA, 43CA, 50D and such other provisions will be brought into operation or not, and 50B and 50 also, which we talked about 50B. The answer could be twofold. It's the general understanding that a law which is specific would prevail over a law which is general. A law which is specific would prevail over a law which is general. Simple understanding is that. Now, in these circumstances of 9B and 50C, which is the law which should prevail? Take a case wherein, say an immobile property belonging to the firm, say a piece of land, has been agreed to be handed over to one of the partners in the course of retirement. Now, in such case, the fair market value could be different than the stamp duty value. Fair market value could be different than the stamp duty value. And in such case, if 50C were to apply, the higher of the two would apply. If 50C were not to be applied, the fair market value alone would apply. Now, in such case, the courts had occasion numerous times to consider which provision will supersede the other one. Is that the first one to hit the tribunal was Carlton Hotel's case. In that case, the Lucknow tribunal famously said it was a case of a 45-3. And the argument was that the amount which is credited in the books of account should be the one which should be considered for the purposes of taxation. The authorities were of the view that stamp duty value being higher, that should be considered. And the tribunal in that decision held that 50C will supersede 45-3. This decision traveled to Allahabad High Court. Allahabad High Court in a different context, negative that decision. But that ruling of the tribunal on 45-3 and 50C is not something which is knocked down by the Allahabad High Court. So therefore, has it become the final law? I would not say so. But that was the decision of a tribunal which is not controverted by the assessee or by the court. So that is one thing we'll have to keep. As against that, you have two Mumbai tribunal decisions, Amartara and Network. In both these decisions, the tribunals have, after Carlton Hotels said, without examining the Carlton Hotels, have stated that yes, that 50C will not override 45-3 or any such other provisions. So this. But having said that, you have a difficult decision it's a special bench decision from Mumbai Tribunal. In the case of United Marine, I should have quoted, I'm sorry for not quoting it. But it's a famous decision which says that, it is not sufficient to say that, which section will supersede one. It's possible that, that both provisions could be specific provisions. When both provisions are specific provisions, like in the example which I gave you, United Marine was a case of section 50, the one dealing with block of assets and computation of short-term capital gain. In that, one of the assets, which was a land and building, was withdrawn by the partner out of the block of asset, and the issue of applying section 50 arose. The special bench of the tribunal held that both the provisions should apply, and because 50C provides you with a value which is higher than the section 50 value, 50C value would prevail. So please look into those decisions before you conclude in a haste. This decision, to my mind, it has been about 15 years. This decision is not yet reversed. So therefore, perhaps it has become a settled position that when two provisions can apply, they are operating, one is also dealing with land, the other one is also dealing with land. 9B is a specific provision, there is no doubt in my mind. But is 50C also a specific provision? The answer is yes. Answer is yes. So therefore, in such circumstances, there is a difficulty. But after United Marine, these two Mumbai tribunal decisions, without considering those that decision, has come to a conclusion. These are not special bench decisions. And while planning, making a serious planning, it may not be any more good to rely on tribunal decisions to plan your affairs. Don't do that. Even High Court decisions at times are susceptible, but tribunal decisions at many times are considered to be convenient decisions. So you can't decide your planning. You'll have to look into your own fundamentals and decide something on the first principles of law, on your understanding, on your training, that may be more stronger. The other issue on deeming fiction is that will come again also, is that please read these two provisions very carefully. What it provides for is that on receipt of the asset or stock in trade or sum of money, there is a transfer. So what it provides is there is a deemed transfer. There is a deemed transfer. It doesn't say that it is a deemed capital gains. It doesn't say that it is a deemed income also. There is a deemed transfer, and thereafter it assumes that then then the chartered accountants and the advocates will decide what to do with such deemed transfer. It doesn't provide clearly that there is a deemed capital gains. In the very limited context, why I'm placing this before you is that if you look into the provision like section 54 EC, it seeks to exempt the capital gains. It seeks to exempt the capital gains which has arisen on transfer. So therefore, in such cases, is there not a possibility to say that yes, there is a deemed transfer, but there is no deeming provision to assume the receipt to be representing a capital receipt, capital gains? It would be taxable, there is no doubt. It could be taxed under the head capital gains also. But in such cases, the difficulty which is placed for your consideration, I believe that a reasonable view at some point would be taken to believe that if you're taxing something under the head capital gains, you better provide me with 54 EC concession also. But before you advise your client to put in 50 lakhs of rupees of earned income, which is otherwise going to be taxed, you should read this aspect little carefully. Death of a partner. Death of a partner. This is in a different context we are seeing this. Think of a case of a firm which has two partners only. 9B provides for dissolution taxation, 45.4 does not. 45.4 does not. Now in such case, the issue which one has to see is that is the firm dissolved or it is not dissolved? Is the firm dissolved or it is not dissolved? If the firm is dissolved, the next question you should be asking yourself is there a receipt? Is there a receipt by one of the partners? One who is surviving at least. We have earlier concluded that a receipt by the legal heirs of the deceased partner would not be something which will be covered by 9B or 44, 9B at least. The issue therefore is in relation to the surviving partner. If he receives it also automatically, then there could be a trouble, and therefore there is a liability to taxation because of the new prescription. You might fall under the earlier decisions of Shakti Metal and other cases. But that was dealing with a very different law, and today you will be dealing with a different law of 9B, which is fiction all the way. So therefore, please look into this. Yes. Then we move to one of the few common questions is that what is the cost of acquisition and the period of holding in the hands of the partner? Fortunately, the same guidelines, circular number 14 of 2nd July 2021, for some reason in its kindness, the board provides that, that this would be the cost in the hands of the partner. But that kindness is a limited kindness. It doesn't even tell you that what would be the period of holding. Obviously, it should also tell me that period of holding also would commence with that. If because it is not provided, I am also tempted to look into the provisions of section 49(1)(3)(a), which says that that in such cases what would be in cases if this is classified as a case of succession, is classified as a cost of case of succession, barring this for this circular of 14, the cost of acquisition will be that of the previous owner, that is of the partnership. But because of this, the kindness which has been shown, it would be so. But when it comes to period of holding, the only thing I can fall back on is to subsection 42A to determine my period of holding. We have reasonably understood that yes, that an ownership by the firm is different than the ownership of a specific partner. A joint ownership is different than the independent ownership. And if that be so, then in such an event, one would be safe in holding that the period of holding would commence from the case of a deemed transfer. I would not relate it to the receipt, but at least the deemed transfer, which is the date of execution of the deed of partnership. This is just, see a kind of a titillator which is placed before you that yes, that if an asset which is otherwise forming a part of block of asset, if it is being transferred in the course of reconstitution, then in such case, in the hands of the firm, what would be the WDV? It will be pulled down or it will not be pulled down. There is no provision for that. And this decision of Mumbai Tribunal confirms that no adjustment in section 43(6) clause C is otherwise provided for. It's otherwise provided for. There is another school of thinking that even if it is not so provided for, as long as the asset does not continue to be used by the partnership, to that extent the law should be rewritten. But we have at least good number of cases which hold that the asset under the scheme of block of asset depreciation, that depreciation would continue to be because it is independent of the user. The user is to be examined only in the first year, and thereafter it is assumed to be used. And once it is assumed to be used, it is part. The only thing for granting depreciation under section 32(1) is to examine whether it is part of block of asset, which is defined under section 2, subsection 11. If that is so, 50 has no role to play, and therefore you would continue to claim the depreciation. This is what this Baidas, Karsandas and Company's case is stating. Agricultural land, see, what happens is, see, I don't really, see, envy the income tax department's job. Like the assessees and the advisors also on their part comes out with beauties at times. This is a case in wherein, the question that is being asked is an agricultural land a capital asset? Obviously, to a simpleton like me, I would say that yes, why not it is? It is a capital asset. But then Pat Kames the respond that it is not a capital asset under section 2, subsection 14. And therefore, because it is not a capital asset, what we are dealing with is a capital asset, which is a capital asset under section 214. And therefore, in that view of the matter, there should not be any taxation when an agricultural land is distributed by the partnership firm, provided the partnership firm is allowed to hold the agricultural land under the state laws. It's a state subject. Now you have all these decisions, Premchand, Yogesh, Mubarak Gafur's decision, which all concur with this in the context of 56(2)(10). In the context of 56(2)(10), they say that an agricultural land for the limited purpose of that is not a capital asset. You have the Trilokchan science decision which says that 56(2)(10) does not refer to a capital asset as is referred to in 2 subsection 14. I, for some reason, agree with the reasoning of the Trilokchan science decision. This decision in Premchand's case has been considered and has not been followed. So therefore, this decision perhaps has lost its value. But the reasoning is something which is appealing to me. I would request you to take your own call. A capital asset here, which is sought to discuss about, is a case of a deemed transfer. See, I don't think it is 2 subsection 14 capital asset. Even if yes, sir.
The definition also too is subject, depending on the context.
Exactly, very well said. Thank you for that. Yes. So therefore, everything has to be understood in the context and not generally. Business on a going concern basis. Now, what is this? Is business a capital asset, or it is something different? See, it's made of so many assets, so many liabilities. In such case, could it be considered as a capital asset? The courts are concurring with the view that it is a capital asset capable of being transferred separately. And if that is so, if one of the businesses of the partnership firm is taken away by one of the retiring partners, there is a case of application of 45(4) as also 9B. How would you compute it? We will see a little later, but this is how it would go. we have talked about this when a partner is not a specified person, then in that case there should be no charge. The intricate issue which is one is trying to examine is at some level this is being discussed is that in the year in which you receive something which was the year of retirement also, there should not be a failure of charge. The charge will fructify and it will hit you badly. But assuming that after having retired, if you receive it subsequently, the law continues the requirement of you being a specified person. Now, in the year of receipt, you are not a specified person. So therefore, is there a lapse on the part of the legislature? I would believe that it could have been worded far better. Far better. It is that the terminology in connection with helps, but the year of taxation is the one which will also require me to examine that whether I am a specified person or not. If I am not, there is an arguable case also. That is. Then perhaps this is the last on common issues is that a family arrangement happens in the course of reconstitution. In the course of reconstitution, there is a family arrangement and in the group of family members. All of them are partners of several firms. The firms are being reconstituted in view of family arrangement. The courts are kind to hold that that such family arrangements are not considered to be the cases liable to taxes, and the reason is courts believe that these are not the cases of transfer. If these are not the cases of transfer, therefore, in that no tax would be leviable under the Act capital gains. This is what is the common understanding. Will this understanding extend further to 9B? Will this understanding extend further to 45(4)? My view is it may not extend. For the reason that yes, that I agree with the courts that while understanding whether the case of family arrangement is a case of transfer under 2 subsection 47 or not. It could be a case of no transfer under section 247. But when you look at 9B and 45(4), you're dealing with a fiction. You're dealing with a fiction, not 2 subsection 47. It deems that there is a transfer on receipt. It deems there is a transfer. Now, can you therefore fall back? I am sure you trust me that the earlier decisions which would come from the tribunal or the courts will support that it is not a transfer, and 9B and 45(4) would not apply. Because it's very easy for the members and the judges also to be carried away by the precedent. And when such huge precedent is available, they would. But a day would come when a commissioner or an officer would argue it out that look, what are you using? You are examining for not 2 subsection 47, you are examining 9B and 45(4). So the transfer which is deemed here is very different. And taking this further, we might have some debates even in the context of section 47 also. Then reconstitution, see that as we have said that if the receipt is in a different year and the reconstitution is a different year and reconstitution is before the amendment was introduced, then in such case, can there be a taxation on the receipt base? These are the decisions, see, 2 are of Madras High Court decisions. Both of them have said in the context of one in the context of liquidation and the other one is in the context of amalgamation. They have stated that yes, that the year of receipt, even if the event had taken place earlier, the receipt would be taxed in the context of 46(2). So therefore, one will have to, these decisions have not been reversed. They are there for quite some time. So therefore, and I agree with these decisions, at least in the context of 46(2), that a receipt could be taxed independent of the event. And if you agree with this view, then there is a difficulty that you will not be anymore be able to argue it out that the law is retrospective in nature and therefore should not apply. The law here would not be considered as retrospective. It would be considered as prospective in nature, and the receipt being in the year in which the law is applicable, the new law, it would be taxed. So this could hit you below the belt. One is that, under old 45(4), on execution of the document, if there was a taxation, then on receipt, there could be another taxation. And mind you, this could be not a pure simple case of double taxation. Don't be naive ever to believe that, the receipt once taxed is being taxed again. These are different forms of taxation. One is taxing an event of retirement, other one is taxing an event of receipt. And therefore, to say that it is the same event which is being taxed once again may be difficult. See, right? I am not a pallbearer, in the sense that, I'm not spreading gloom. But the idea is that in a discussion in an elite audience, it's important that, that we understand our responsibilities also and not be very, very aggressive without there being any basis for holding such. Just because the courts have in some different circumstances held that double taxation is not under the scheme of Income Tax Act. But these very courts have also stated that if there are two different charges, both of them may succeed. So therefore, please be careful about this. Then reconstitution, carrying it further, yes, that if there is a change in the remuneration, as the change in the profit sharing ratio is considered as a case of reconstitution. But for some other reason, by the change in the share of remuneration, if you are achieving the same effect which you wanted to achieve otherwise by changing the share in profits, then in such cases, provisions of 9B and 45(4) would not apply. I don't think there is another view possible, but this is this. The other possibilities could be cases of a statutory conversion. When Chapter 21, which is the erstwhile Chapter 9 of the 1956 Companies Act, in such case, when a conversion happens, then in such case, could it be considered as a case of reconstitution? I would believe not. It doesn't fit into the definition of reconstitution in 9B, and therefore it may not help the authorities to say that there was a reconstitution. Similarly, where there is a statutory conversion of a firm to LLP under the provisions of Schedule 2 and 3 of the LLP Act, then in that case, could you say this is a case of reconstitution? Everything is reconstitution. Make no mistakes about it. I have no such belief that it is not. But the point is it a reconstitution as is defined under explanation to Section 49B? The answer could be no. Similarly, if there is a statutory dissolution, if a partner turns insolvent, or he turns into an unsound mind, and if there is an automatic dissolution, it could be a case of dissolution, but could it be considered as a dissolution for the purposes of 49B? Because dissolution is not something which is defined under the Income Tax Act, and therefore one will have to take his own view. I believe that there would be a better case for the authorities to say it is a case of a dissolution in the context of this, because it is not defined. But when it comes to reconstitution, I am clear that there is no reconstitution for the purposes of 9B and 45. If you look into this, reconstitution is defined to cover a case of change in profit sharing ratio. In such case, a devil might think that, if I change the loss sharing ratio, will it be considered as a reconstitution at all? Literally reading, I believe that yes, a change in loss sharing ratio is not a case of reconstitution. Unless you are magnanimous to say a profit includes loss, in this context of a fiction, I don't think I have to apply the general law. Will not be so charitable with this. There is a difficulty. Death of one partner out of the two partners, does it result into dissolution? These are the two decisions. The first one is Vasudevan's decision. The other one is Ahmedabad Tribunal decision, which is Pramod Kumar's decision. Both of them hold that yes, that there is a dissolution, and if there is a dissolution, the provisions could apply, as we have discussed. Carrying it further, is that what exactly is reconstitution otherwise? Yes, right now. Supreme Court in Renu Sagar's case under a general law stated reconstitution is a term of the widest import and amplitude. But the trouble here is you have taken care to define it. Had you left it to the wisdom of the law, then in that case this difficulty would not have arisen. This appears to be, this is. Later on, Supreme Court says that it covers previous events as also subsequent events. I agree with this, and this to an extent supports the possibility that a receipt in a later year by a retired partner could be brought to tax under the general understanding of reconstitution, but against under the narrower definition supplied by the provisions of section 9b, which will also hit 45.4, there is a possibility this thing. But this Allahabad full bench is an interesting decision, which says that there must be a substantial or a direct connection. If it is an indirect connection, it is just flowing out of it, not out of the agreement, there is a possibility. And why this is being discussed is, for non-payment, if later on, if the damages are being paid to the retiring partner, then it is, yes, he has a right to receive such damages, but it is not directly connected to his retirement. His right to receive something on retirement. And therefore, there is a possibility that you may look into this. The rest of the decisions have occasion to examine what is a reconstitution, independent of the definition of reconstitution. Deeming fiction is again, see, it's something as students we will have to keep on understanding. What does one mean by deemed transfer? This deemed transfer is something which overrides the usual concept of transfer under section 247. If it does override the usual to subsection 47, which is a possibility, then in that case, all that which you understand with reference to computation of capital gains, especially section 54 chapter benefits, 54 EC and other G and GA, and importantly section 47. All of them may not help you. Section 47 says that it lists down about 30 cases of the cases which are not considered to be transferred. Here is a case which is considered to be, specifically considered to be a transfer. So can you therefore not say that, it overrides section 47? Debatable. I'll keep my fingers crossed, and therefore I would not take a view. By stating that because 47 overrides a case of a two subsection 47 transfer, the charge under 9b fails, there is a possibility that it may not. It's something, which could be a serious legal debate, which will also bother you in the context of claiming 54 EC as well. Keep that in mind. See, what's happening is that, the explanatory memorandum clearly provides that these provisions are introduced in order to overrule the understanding that where there is no transfer, then the charge fails. So Supreme Court in two famous landmark cases has stated that yes, that where there is no transfer, there is no capital gains tax. Yes. So these decisions hold the sway today also, independent of 45.4. These decisions may to hold today. So when a fiction is introduced over this, then in that case, there is a transfer for the limited purpose of 9b. In fact, in 45.4, the way we are moving ahead, we'll have to now move faster. It is 1:30 and we have a lot to cover. But yes, whatever we would cover, we will try to cover it best. That's one. Second is, if I am not able to cover some of the slides, you may carry, my email ID, and I will surely reply to you in writing about any of the things which I have not discussed. But whatever I want to say is placed in these PowerPoints. The issues are identified. Please take your own call. So therefore, nothing is left untouched. This is the short this thing. Which section will apply? These guidelines perhaps someplace clarify that 9B will apply first and 45.4 would follow. So they may apply together, but in the terms of priority, you will have to test 9B first and then move to 45, receipt-based taxation. Now there are specific issues, few relating to 9B, The first and the foremost provision, the difficulty is what is 9B? Is it a charging provision, or it is a computation provision, or it is a combination of both? What does 9B do? When you contradisting this, when you compare this with 45.4, you will see that that 45.4 begins with a notwithstanding provision, while 9B does not have a notwithstanding provision. So therefore, it does not have the audacity to override other provisions. It doesn't say that notwithstanding other provisions of the Income Tax Act. So it would be fair to assume that this 9B in itself does not override. What it does therefore is, it tells you that what would be the year of taxation. It tells you what would be the head of taxation. It creates a chargeability, it tells you that how the full value of consideration should be determined by referring to fair market value. Barring these three contributions, it is not overriding other provisions of the Income Tax Act. It's not overriding other provisions of the Income Tax. So other provisions of the Income Tax Act would apply if they are otherwise applicable. If they are otherwise applicable in light of what we just now discussed, that it is providing for a deeming transfer. So therefore, other provisions when applicable, not because they are cases of transfer, but they fit into 9B, then in that case that would apply. So answering this question is that it is a computation provision which has tweaked certain parameters of computation with reference to the full value of consideration, the year of transfer, and the head of taxation. Barring these three things, it has not changed anything. But when it comes to section 28, because 9B also provides for taxation of PGBP, that is profits and gains of business operation. Will it not be that, to say that, okay, the fair market value of stock in trade would be taxed in the year of receipt? It's all right, I am willing to pay tax, but you need to allow me the deduction for my expenses, my losses, which I have carried forward, the losses of that year. There could be a possibility that on adoption of fair market value, there could be losses, provided you allow me the cost of acquisition of the stock in trade. There is no express provision for allowing this. But the important point is that the capital gains or PGBP which is to be computed is the one which is required to be in accordance with. And this in accordance with has a special significance. In accordance with would mean in conformity with the other provisions of the Income Tax Act. The courts have examined this language. What does the Act legislature mean by using the term in accordance with? So in a manner which is conforming with the existing provisions which are not in conflict with the provisions which are special provisions or the regular provisions. If we understand this, there should not be a difficulty. But this also, mind you, most of this discussion which is taking place today, I've been testing it over a period of last 4 months. And all those issues which I based, they were the figments of my imagination. I have filtered them out. And I'm not troubling with those things, So these are the issues which would surely arise at one point of time in real life also. So please respect this thing. There is an interesting difficulty, see that 44 AD when it applies, it presumes that my income would be presumed to be 8% of certain turnover. Now 9B says that that income should be taxed under the Act PGBP, independent of turnover. Now, so should 9B run parallelly with 44 AD? Because there is a presumption. 44 AD is a presumptive taxation which brings a curtain on any computation of profit and gains. It simply says you determine my turnover, apply 6% digital, non-digital 8%, and that is it. So the question, at least for us as student, is appealing that in such cases, see, will 9B be separate computation for the purposes of computing profits and gains of business or profession? I think, it may be difficult, but let's see. Then diminfiction of rule 8AA5. Will it apply to 9B or not? 8AA5, as Falgun Kumar has told you, that it is for the purposes of characterizing, classifying the capital gains into two parts. Fortunately, 8AA5 does not bring a fiction over a fiction by stating that a part of your capital gain is a short-term capital gain and the other part is long-term. This is a simple provision. If the asset which is transferred is a short-term capital asset, let it be so. If it is not so, it is not so. Then it will be long-term. The important significance of what we are discussing would be strongly felt in the context of the goodwill or the self-generated asset. In such case, there will be no fiction to assume that this is a short-term capital asset. If it is long-term, it would remain to be long-term. And there could be many other cases when you look into this with a little, deeper microscope, you will understand. There is no doubt that this is a case of double taxation, but in the order of priority, 9B is the first taxation. And if there is a taxation, again, it is 45(4) taxation. But yes, simply because the tax is payable by the firm, it may not be possible for you to argue that this is a case of double taxation and therefore one of it only should prevail. Yes, the tax is being paid by the firm, but it would be paid in two different ways. Characterization would be based on your period of holding as per section 2 subsection 42A with all different avatars in its explanation 1. So therefore, and rule 8 does not apply. This is something which we need to see. I have a serious difficulty, someday it should be taken up, is that this entire guidelines which has been provided, rules which have been framed by the government on its own, on its own. If you look into 9B4 or 5, see it says the power is vested in the CBDT to frame rules in confirmation with central government on its approval. And later on, when it is approved by both the houses of the parliament within 6 months, they become the law and it will be binding on the assessing officer and also the assessing. But the important thing is that it is for the purposes of removing difficulties. Removing difficulties have to be identified. Why do you draft laws and enact laws which even before understood by anybody, you yourself have difficulties in understanding your own words? So it's your difficulty or the assessor's difficulty. This particular aspect has been examined by the courts in several other cases also. So when you look into this, then you will have to understand that if you introduce something for the purposes of removing difficulties, that means CII or SOCHM or FICCI or the Institute of Chartered Accountants must have faced you, represented before you, based again on their real life experience, that these are the difficulties which are being expressed. And therefore, Are you clearing the difficulties or are you clearing your own doubts? This is what it is. And according to me, there are Supreme Court decisions in this support, because this is not the forum to discuss this. Not that I am in any manner, considering this to be not the fittest forum. I respect my ICAI as the best forum for the reason that this is highly controversial and would have taken, long time to discuss. But the law is clear that presently the government had no power to issue these guidelines. An identical issue arises in the context of 194R, which is of a larger importance in the context of 194S, in the context of 206C, 206H. They keep on issuing this, in the name of removing difficulties. But they create difficulties. And look at this, see the way it is worded, nobody in its common mind, would have drafted such rules, right? You could have simply stated that I will tax you the entire thing as short-term capital gain. See, what happens is that you bring in laws which are uncharitable, which are unkind to the taxpayers, which are absolutely wrong, which are stories of fictions, and thereafter your conscience bites you. That you feel sorry for having brought such law, having given birth to such a child. So therefore you want to give something. Then you make such laws. We will divide it into short term and long term. Then you further make laws which says, I'll allow you to add or reduce the full value of consideration on a subsequent transfer. All this is unheard of, see. Yeah, these kind of fictions, they don't happen in movies, not even in southern movies. So therefore, Rajnikant is no more, a person who is being followed. So therefore, all this is something which we need to be very careful. What kind of, trouble you are inflicting on the taxpayers, see, and partnership is not an ordinary taxation. This country does its business, 90% of business, through partnership. Now, why would you trouble them with such kind of law? Who is there to understand these kind of laws? No, it's not possible to understand. For people who are into understanding these laws, have not been able to understand it even after 4 months or one year and 4 months of its introduction. There is a problem. Then carrying it further. Again, here charge or computation, the short of it is that here at least there is an overriding provision. It starts with notwithstanding, but the override is limited to provisions of section 45(1). All other provisions of computation would therefore apply, and the difficulty here is that it is a unique method of computing. So all your provisions of section 45 to 55, in my very, very respectful opinion, would not apply. It is overriding 45(1), but it also does not permit you to apply 48 and other provisions. It provides a very unique formula of computing the amount which is taxable. Though they say it will be taxed under the head capital gains, but what is being taxed is surely not a capital gains. It's an unknown animal altogether. So therefore, whether the period of holding is not relevant, the period of you being a partner is not irrelevant, and most important is the cost of acquisition of the asset which is being transferred is also not relevant. No substitution of fair market value, no indexation. And if all this is not permissible, this is the collective mechanism which runs the vehicle of capital gains. If this is not available, how could you claim 54 EC? Is a question which I am repeatedly putting it up before. So there is a very unique method of computation. And what is computed is surely not a capital gain or a profit which I understand. It's not even a commercial profit. It's absolutely different. It's also not a simple thing like 9B. 9B is otherwise simple. I have no issues with government over there. But 45(4) is a very different thing. It does not allow you deduction for cost of acquisition. It allows you a deduction for a capital balance. But when it allows you a deduction for capital balance, like in Mohanbhai Pamabhai's case and other things, one would believe that what you want to tax me, tax a partner, you're not taxing a firm. In Mohanbhai Pamabhai and other two cases, Raghu Kumar and Tribhuvan Das, the issue was whether a partner could be taxed or not. And if you wanted to override Supreme Court decisions, fine, we would be with you. Then tax it in so many words. Here you are taxing, you are allowing me a deduction on account of capital balance, but you are not holding this to be a transfer of my interest in a partnership firm. What, in a very super stupendous manner, what you are doing is that you are saying that what I am transferring is my interest in the assets which are retained by the partnership firm. I am required to revalue those assets. And based on that, if an amount is paid to me, that is what I am trying to tax. And when you do so, when you try to advance the taxation of a assumed future transfer, your conscience will bite you continuously. And therefore you come with 48.3, therefore you come with Rule 8AB and such other things. It's even when I'm talking with you, see, it just hits me up, that how would you think about such provisions of taxing a future gain and advancing the taxation? Why don't you simply say that whatever amount is paid to a retiring partner, yes, less the capital would be allowed. That is what Vasudevan said in that Lakshmi's decision, that you should allow a deduction for the capital gain, capital which is held. And he said that it should be revalued also. So now what is happening is that a future gain is advanced, taxation of it is advanced today. And then you are told that don't worry, sir, because we need money, we are taxing you, but whatever money we are collecting from you, we will refund it to you at a later point of time. Why do you do this? What business you have? And which government you are running? See, for once, yes, one believes that this can be done only in a banana capital, nowhere else. Who are these persons? I am for sure that Mrs. Sitaraman would never agree to these kind of things had she understood this. It is those Johnnies who sit into the North Block, see, they have their own ideas. They are given, a mandate by some officers कि इसको tax लगाना है, तो tax लगा देते. Then they realize कि अरे जो लगाया है वो तो उसका कैसे, it is like the tail is on the front and the face is in the back side. So ऐसा कुछ बना दिया है. So then they would try to tweak it further by introducing fiction over a fiction. To me, see, any decent finance minister should give a go by at least to 48.3. It should give a go by to Rule 8AB. If you do so, the rest of the taxation is simple. Or we will devise ways to give you taxes. That's not the case. You say we don't like Mohanbhai Pamabhai. It's all right. Doesn't matter. But here what you are doing is very different. Here what you are doing is very different. You then, in a very charitable ways, you have highlighted this is that they have allowed us the credit of the profit which we make on 9B, which is not statutorily provided. And then you do such kind of things. Why do you do this? It's not fair. Right, okay. Further. So deduction is given of a capital balance. And in that balance, you are allowed to add your share of profit, which would have which is taxed under 9B. Now this is not there in 45.4, but it is not there in rules also, but it is there in guidelines. It is there in guidelines. So that, and obviously this is, once it is passed by the legislature, it will be binding on the officers also. Yeah, few things, see, for your, way home is that, what is a capital account? Deduction is given for balance in capital account. What is a capital account? Yes. So are any one of these a capital account or all of them are a capital account? Now, the law further states that deduction for capital account in represented in any manner. So could I therefore say that at least, see this current account, loan account, write-backs, statutory reserves, surpluses which have remained to be credited, at least some of them should be considered as capital account, and therefore, because it's the law has taken pains to say represented in any manner. So therefore, please look into that. Yes, 2 minutes, we'll close this. This I have already told you that credit for share of profit would be given, but credit for revaluation profit, even if it is done, is expressly prohibited by the proviso to section 45(4). So therefore, that credit is not possible, but 9B credit is possible. This is interesting that what if there is a negative balance? Two things we will take home on this is, one is that if the computation that is A is equal to B plus C minus D is resulting into a negative balance, it is a case of a loss under the head capital gains. But the law says in such case, such a negative balance should be ignored and should be treated as zero. So therefore, you cannot set it off. That's all right, period. But what if I have a negative capital balance itself? Then in such case, two situations can arise. One is that I should be allowed to ignore that. The other one is that that negative should be added to this. This is what is Summit Corporation is all about in the context of 50B. So therefore, it is an open issue. You will have to take your own call. I would argue it out. That I would not, because most of the things which we are presenting today in favor of the taxpayers is only because you are dealing with an unknown creature and an absolute fiction. So in a fiction, you can't add more fictions. That is, and you don't even try to rationalize the fictions. Don't supply logic because it is never intended to be supplied. So where is the question of supplying logic? It may be illogical, but sir, then that is what is meant to be. This whole provision is illogical. So don't even attempt to look into the logic of this thing. Entire madness. Don't do that. Retirement at book value, yes, it should be possible. There should be, unless there is a transfer of a capital asset. If that is so, then in that case, even if it is at a book value, fair market value will have to be taken into consideration. This is that, this is little different, is that what happens is a firm revalues the assets. A firm revalues the assets. Later on, after revaluation, it is converted into an LLP, which again is a firm for the purposes of 9B and 45(4). In such case, and I would surely revalue the assets as a partnership firm, which is not an LLP, for the benefit of 47(13)B and other provisions. So in such cases, is the historical revaluation by my predecessor firm would not be ignored, or would it be ignored? That is the case. I would once again hold that revaluation has to be considered, and all my capital accounts which are credited after such a revaluation should not be retweaked in order to enhance the amount of capital gains. Recognition of future profit, and I think with this I'll sit down, is that assuming that you are following a project completion method of accounting, whereunder you will recognize the profit for the project at the end of the completion of the project. And at the time of retirement, the retired partner says that itna kaam ho gaya hai, so let us recognize the profit. So you may not recognize it in the books of account, or even in the books of account if you recognize that profit. Would that add to the capital balance? The answer apparently is why not? Why not? But would it be subjected to tax under 9B or 45(4)? The answer is no, it could not, it cannot be. It's not part of capital gain, nor it is part of profits and gains, business or profession. it will have its own fate independent under section 28. Just because you have accounted for it, but under a method of accounting, if the taxation is deferred, it would be deferred. It would be taxed at some day, but it would not be under 9B or 45. Case of double taxation, I have said it is not. And this SGG, that is self-generated goodwill and self-generated asset, I have explained that that it has to be treated independently. Succession issues, that also we have considered that cases which are conversion, those cases may not be considered as the cases of reconstitution. Non-resident partner, the limited issue which you have to, there are certain treaties which admit of taxation either of a partner or that of a firm. So it's fungible. Now in such cases, say if the non-resident firm offers for taxation in the hands of the firm, then in such cases, even though it is taxable, there is no receipt by a partner, and therefore there is a possibility, a view has been canvassed that in such cases, the provision would fail. An example is given, there are many others, but it's something we'll have to look into this. Dissolution, as I said, is not defined, but surely 45(4) would not bite a case of a dissolution, only a case of reconstitution. This is another thing you will have to keep in mind. Perhaps this is the last slide. This is a case of DLF Universal. It's a special bench decision delivered some many years back. It was a case of 45(3), in which a stock-in trade was sought to be introduced at cost. And the government said that 45(3) ke liye bhi market value lagega. That's what. And special bench has approved this. It has said that stock-in trade, so what? At the moment when it is being introduced, similarly in our case, at the moment when it is being received, there is nothing like stock-in trade. Everything is capital asset. Everything is a capital asset. So this is an obnoxious decision which again is not even challenged in the High Court, not overruled, not even looked into by another cases. So therefore, if you're planning around this, you should be very careful that stock-in trade is also considered to be a capital asset in terms of transactions between firm and partners. There is nothing like stock-in trade because the partner is not a dealer in such stock-in trade. And your intention is also not to sell to the partner. So in such case, the transactions are on capital count. Since initially, some 20 years back when this decision came, I was not happy with this. But the more I read, I feel that I have become more wiser that there is a merit in that decision. Yes. This we have discussed. Cost of acquisition and period of holding, this also we have discussed. Well, this, I am happy that, time is running out and I am not required to deal with 8AB and 8AA, which otherwise also are very difficult provisions. Well, ladies and gentlemen, thank you so much. And thank you, SIRC, for giving me an opportunity to explain. If there are questions, see, it could be forwarded to me because it is just a minute short of 2 o'clock. So let's all disperse for lunch, right? Thank you so much.